Okay, good morning, everybody. Welcome to our panel. We're going to be talking about the change that's going to hit the banking sector over the next couple of years. My name is Joumanna Bercetche. I am a Bloomberg television anchor. Really delighted to be moderating this panel today. And we are going to be talking about some of the mega trends that the financial sector is going to be sort of contending with over the course of the next few years, but also over the medium term, long term. We're going to be talking about some of the macro drivers, geopolitics, sustainability, technological advances, and of course, we're going to talk about regulation as well. A few things have happened in the last 24 hours, so we might touch on that as well. Just a couple of housekeeping points. If you want to tweet about the session or whichever social media platform you're on, you can write about it with the hashtag WEF25. And then if we have time, and I'm conscious that there are a lot of panelists today, I may open up for a couple of questions. So without further ado, let me just introduce our panelists, starting with Robin Vince, President and Chief Executive Officer of BNY. Then we have CS Venkatakrishnan, the Group CEO of Barclays. We have Bill Winters, the Group Chief Executive of Standard Chartered. Mary Callahan Erdoes, Chief Executive Officer of JP Morgan Asset and Wealth Management from JP Morgan Chase. And then His Excellency Sheikh Bandar bin Mohammed bin Saoud Al-Thani, the Governor of the Qatar Central Bank and Chairman of QIA. So Mary, I'm actually going to start with you, namely because JP Morgan posted record profits for the year last year, and we really saw a lot of momentum kick in the fourth quarter. There's a perception that things are going to look up for the sector this year, be it on deal making, be it on a lighter touch regulation. Do you expect these tailwinds to continue going into 2025?
Yes, well, I think we're all very excited to be here to kick off Davos 2025. And I think animal spirits are alive, as Stan Druckenmiller said yesterday. We have a world that is changing quickly, as seen by the last several hours of the new administration. And I think all of it is hopefully going to manifest itself in the US economy and economies around the world. And so we're very hopeful that we do get a lighter touch regulatory environment. Regulations, as we know, are very important for almost every industry in the world, but in banking, it's particularly stifling, particularly when it comes to lending and keeping the global economies going. And so if you look at the last administration and the number of new significant regulations, it's 8 times the number of significant new regulations versus the prior Trump administration. And so with that comes multiple millions of man-hours of paperwork and other things that clog up the system and stop the economy from continuing to have that very healthy flywheel. So we're really looking forward to that. It also manifests itself in the ability for people to invest in the great companies that want to come and take themselves public. If you just look at what's happened over the last several decades, 30 years ago, we had 7,300 public companies. Today, we have 4,300. Mm-hmm. But 20 years ago, we had 1,900 private companies, and today we have 11,000. And so what's that telling you? It's telling you the companies don't want to go public or can't go public because of the heavy regulatory burden. And hopefully you'll see that be able to enable the general public all around the world to invest in the great companies that are taking themselves out.
Just to add to that point, just on the slowdown in M&A activity, is it just because of regulatory headwinds or also the interest rate environment? Because we've also been in a high interest rate environment as well.
Yeah, well, I think interest rates are fairly moderate given the environment that we're in. They're not overly restrictive, and I think that all of it will come together, hopefully in a way that will fuel the economy. And I think all of us will participate in that. And you're going to see it in everybody's earnings. And I think that it's just the beginning of really go mode here. And I think we're very excited about it.
Okay, beginning of go mode. Robin, let me ask you, from your perspective, I mean, are you thinking of revamping your business model based on the expectation that the incoming administration is going to have a more permissive approach to regulation?
Well, the way that we think about this is our business ultimately attaches to a whole bunch of megatrends that are going on in the world right now. You know, Mary was talking about one of them, which is growth, and that's a really important one because growth enables capital markets. And so a participant in capital markets, we get to be able to really take our financial services platforms and be able to support our clients. And so that's really helping them to be able to then go forward and participate in that growth. So capital markets activity is one, it's powered by growth. Another one is towards alternatives as an asset class. That's an important evolution. The US wealth market is an important evolution. Companies focusing on what they're great at and outsourcing is another one. So when you look across all of these different megatrends, there's clearly this opportunity, I think, for firms like ours here on the stage to be able to actually go forward and contribute. I'll pause because I think my microphone isn't working.
Yeah, well, and hopefully your microphone gets fixed, but I do want to ask, there may be unintended consequences of dialing down on regulation, and feel free, any of the others, to weigh in on this. It was not so long ago, 2023, we were talking about the failure of some of the regional banks, and some of the views out there were that the dialing back of Dodd-Frank regulation was partially responsible for some of the failures that we had in 2023. Is there a risk that this deregulatory drive could end up with some unintended consequences further down the track for the banking sector?
Right, maybe I'll start. So I don't think any of us here is saying that we should not have regulation. We think it's important for the financial sector to be well regulated. What we're seeking for is a balance, right? A balance that combines fairness, the ability to protect the institutions from bad outcomes, but at the same time to facilitate lending, economic growth in the countries in which we are involved in, and to do it in an open and transparent way. That's, I think, basically what we're asking for and seeking in the various jurisdictions in which we operate.
Robin, did you want to add to that?
Yeah. Look, regulation has been stifling, I'll borrow Mary's term, over the course of the past few years. And it's really against the whole purpose that governments around the world have of sort of trying to enable growth for their countries. And I think if there's one thing that we've learned over the course of the past year or two, it's that if you don't have growth, you don't have the ability to pay for everything else that you want to do. There are so many governments around the world that have these great ambitions. They want to build infrastructure. They want to be able to invest in their public services. They want to be able to promote the lifting up of populations around the world. If you don't have growth in your economy, you can't do that. And so why would you have excessive regulation that ultimately are going to stifle growth? We need the right regulation. It needs to be supportive, but it needs to be in furtherance of the growth goal.
Yeah. So here we're talking about the Basel III endgame, but what we need to talk about is every jurisdiction has their own regulatory framework. And I think we are ending up in a situation where there is scope for regulatory divergence between, say, the regulation that is applied to European banks versus, say, the regulation that is applied to US banks. UK recently also announced that they're delaying the implementation of the Basel endgame as well. How do you think of this sort of regulatory global divergence right now, Bill?
It's a real issue, but I think this is a good time to take a step back and think about what works in regulation and what doesn't. Going into the financial crisis, we had very low levels of capital and very uneven levels of liquidity. And that turned out to be a disaster during the financial crisis. Both of those things have been addressed through a kind of brute force. So you can Basel III endgame, frankly, is fine-tuning. It doesn't matter. And even the US banks that got very upset at the prospect of significant increases, it's not really going to matter at the end of the day. Business model shift. And but once you got the appropriate level of capital and liquidity, it's entirely necessary to step back hugely from the microprudential supervision that banks are subjected to. Thousands and thousands and thousands and thousands of man-hours spent complying with micro rules, with highly intrusive regulation into the basics of a business model that can't possibly be caught by a regulator, as we saw with Silicon Valley Bank and others. There were basic flaws in the operating model at those banks that were exposed during a time of stress. Had they had the basics right of capital and liquidity, they wouldn't have had those problems. So when we talk about regulation, I mean, sometimes we're talking about, we're being asked to have too much capital. I say forget that fight. We're guaranteed by governments. JP Morgan is guaranteed by the US government, as we saw. Every bank in the United States was guaranteed by the US government after Silicon Valley Bank went bankrupt. That's a disastrous outcome for society. And the same thing would happen in most other parts of the world. So as long as we have that government backstop, we're going to be subject to capital requirements. Let's live with it. But let's focus on getting the really intrusive part of regulation out of the game. And then once we've got the capital set appropriately, let's get it set consistently globally so that we don't have this arbitrage from market to market. That Basel 3.1 or 3.1 endgame, we'll see if we can get there. I'm a little bit skeptical that we're going to land, but maybe we're converging.
Yeah, it doesn't seem like that the wheels are in motion there. Your Excellency, as central bank governor, you also play a role as a regulator as well for the financial system. I'm just curious to see how you, from your standpoint, how you think not just regulation, but some of these other trends that I touched on at the top are going to influence the direction of travel for the financial industry.
Yeah, thank you for having me here, Joumanna. First of all, as a regulator, how do we look to the financial sector? Our main role as a regulator is to protect the financial sector and to protect the banks and make it the financial industry more stable and bring stability to the financial industry. If you go back, why the banking sector is heavily regulated now? Let's go back to 2007, 2008. After financial crisis, the regulator became more conservative. But I think now everything has been changed. The banks were very well capitalized. The market is doing well. So what we need to do, we need to take a balanced approach, regulation. Balanced approach where we are not too much easy and too much conservative here, and to balance between the new emerging, for example, a new emerging trend in the market, such as technology. Technology now, if you look to the technology, it emerged with its risk as well. But shall we prevent that or allow that? No, I'm with allowing the new technology and the banks to be able to utilize the technology. And the regulator should be there to protect the banks by issuing guidelines to protect the banks and the customer data as well.
Yeah. So it's finding that balance really between allowing for innovation but also keeping the system safe. Venkat, I want to,
Can I just chime in on that?
Of course.
Because sometimes when we are up here every year talking about banks and bank regulations, it sounds very self-serving. But if you just think about almost every scenario where you need regulations in government and public and private sector to come together, as His Excellency was saying. And you just look at some of the issues that we've been having most recently on the energy front, and California is a perfect example of that, where you have the best intentions of regulations to try to control burn in California or to try and figure out the safety and security of water. And then you result in California fires because you haven't done controlled burn, you haven't had a reservoir built since 1979, you don't have the fabric and materials to build fireproof housing, and you end up with the disaster that we've had. And the same thing is being talked about overnight about Germany and the fabulous success that Europe has had on the move to electrify most of that they've done with renewables. 50% of what is done on the manufacturing sector in Europe is done with renewables. But the problem is now Europe has 5 times the cost of manufacturing that some of these other countries, particularly China and India, but even twice as much as US. And so you say to yourself, no wonder Germany has now found itself last night on the bottom of the list of the 30 countries with GDP growth forecasts for next year. And like, you've got to figure out how you get those two things in balance. It's not just about banking and banking regulations.
Yeah, and I think that's a nice segue to what I was going to ask Venkat, actually, because you penned an op-ed this weekend in the UK Times about some of the growth and productivity challenges facing the UK. Obviously, UK bank, big exposure to the US. US banks seem to be benefiting from a bunch of these tailwinds, be they on growth and sort of a lighter regulatory or expected lighter regulatory touch in the future. But in the UK, and Mary just highlighted some of the issues facing Europe as a whole, but they're also very pertinent to the UK too. There's a serious competitiveness and productivity challenge. As a UK bank, how do you counter some of those sort of strategic headwinds or long-term headwinds?
Yeah, so What I would say at the beginning is that I'm very optimistic about the UK. I think it is a very open economy. It's a dynamic economy. It's got great skills, great soft advantages, law, language, location, education, learning. But it's also got a lot of hard skills, the financial sector being one of them, the second biggest in the world after New York, but also in semiconductors, in life sciences. So there's a lot in the UK to commend it. But it comes back to what we said. Mary said it, Robin said it, everybody has said it, which is that what we're trying to get is economic growth. Mm-hmm. And we're trying to get economic growth in the context of a free economy. And banks play a role in it, but we are not the only people who play a role in it. We are there as transmitting credit. And what I was saying in the op-ed is that there's a lot to be optimistic about in the UK, and what people should look for is the continued effort, which this government has been doing, to be clear about what it's going to do in regulatory reform. As you said, Basel has been postponed in the UK for a couple of years, till 27. What it's doing in regulatory reform, what it is doing to free up investment in the country, across the country. And I think that's what's important.
Yeah. Robin, you wanted to weigh in? Yeah.
Just hearing some of the folks on the panel talk about this, it sort of reminds me that, all of us here run large organizations. And when we're trying to achieve a goal, we try to line up all of the pieces at our disposal in furtherance of that North Star. And so we're driving our organizations in a way we're trying to coordinate all of the different pieces to achieve that objective. And I think there's a little bit of a lesson here for leaders of the various different countries around the world as they're thinking about what is their North Star. And the UK is a good example. They've declared it as growth. And then how do they line up all of the various components in furtherance of that objective? And so the UK has talked quite a bit about the fact that they need to reform planning and permitting in furtherance of making growth easier, to invest in infrastructure, to attract new investment in. And so thinking about it in that way, how do we run countries over time to be the best performers that they possibly can be, with all of the individual components pointing in the same direction to achieve the goal?
I mean, tying it back to sort of, global growth, and I have conversations with people, and I've had over the last couple of months, people continue to emphasize this concept of U.S. exceptionalism, the fact that the U.S. is powering ahead. As Mary said at the top, it's go time. Bill, from an international bank standpoint, how do you remain competitive versus the U.S. banks?
Well, our role at Standard Chartered Bank is to be a connector between different markets. The U.S. is one of those connectors. So we have a big business in the U.S., certainly not on the scale of either J.P. Morgan, Barclays, or BNY Mellon. But it's a very important connector market for us. And as much as we talk about globalization going into reverse, it's not. But it's changing its nature very fundamentally. Trade volumes are going up and will continue to go up. We'll see some really interesting ructions, I think, as the Trump administration settles in. We'll see what comes through in terms of tariffs and reconciliation. But we know that China is a very big part of that in terms of having a gigantic export surplus. And that will be under attack from all parts of the world. So the question for us is, how does that connector role change? It's still going to be there, and I think we're well positioned to take advantage of that, as are most banks that play that role. I think that it's probably tougher for banks that are purely local in low growth markets. And but as a practical matter, there are fewer and fewer of those, and those are the ones that will consolidate quite aggressively. Alternatively, the global banks that are able to take advantage of this connector status, or who have a big business in these very fast-growing markets like the U.S., will have a competitive advantage.
Your Excellency, I want to ask you about growth before I move on to another topic. We've talked about some of the headwinds perhaps facing Europe, UK economy. US seems to be on the right track for now. How do you see it from your standpoint, and just sort of the signs, the signals you're getting from the East and from the West?
Actually, I would like to start referring to the latest publication by the IMF. IMF latest publication, they are forecasting, expecting that the global economy will grow by 3.3% 2025. Comparing to 2024, we will do better if we reach 3.3. However, if we compare it to the period from 2000 to 2019, average, global economy grown by 3.7%, so below the average, historical average percentage. So, and that all due to a lot of factors. One of them is geopolitical tension, and the inflation significantly has been declined. However, it still remain elevated. Also, the supply chain has been eased, but if the geopolitical tension is going to increase more, then that will affect, of course, the supply chain, will affect the inflation as well. So global economy expected to grow by 3.3%, but it all depends on what's going to happen relating to geopolitical tension.
Yeah, very fair. Robin, I want to ask you about artificial intelligence. And I just wonder whether we're placing too much hope on AI and the application of AI and what it can, what sort of impact, bottom line impact it can have on the financial sector. I also just want to draw everyone's attention to a Bloomberg intelligence report that I read this morning. I thought it was really interesting. Our own analysts think that job cuts could reach 200,000 in the next 3 to 5 years, but that productivity gains will be as much as 5%. How are you thinking about it?
Well, at BNY, we're very enthusiastic about AI. We think it's going to have a very fundamental impact on the world. Pick your analogy from the past. You know, some people use the invention of the phone or the internet. I actually go back to electricity. I think it is as fundamental as that in a lot of different ways. Number one, there's a bedrock capability here which is going to enable a lot of builders to create super interesting things. And I think many of the things that are interesting are things that are even hard to conceive of today. Just as the folks who first really promulgated electricity commercially had the light bulb in mind, they probably didn't imagine so many of the other inventions that would follow. In our industry, we're an industry of knowledge work. And AI really is an intelligence machine that will ultimately create leverage for humans, where we will have agents, digital employees, as we think about them now in our company, who are going to work as part of the workforce, doing tasks, creating capabilities, helping us to push forward faster than otherwise we would. And so I'm will ultimately do, and I think it will bring a lot of positive development. But you pointed out an important point, which is we're going to have to manage through the important impacts that it's going to have on workforces, and we're going to be able to hopefully enjoy the productivity benefits that it'll have over a longer range period of time.
Mary, is AI a game changer?
Absolutely. I mean, we are in the most fundamental change across all industries everywhere in the world. And actually, some of the greatest beneficiaries are going to be the countries that haven't been able to keep up in the past, and they can leapfrog and go forward. If you're curious and you move fast, you're going to win here. And so you think about, we spend $18 billion on technology every year. We are plowing that into investments across the board. We already have 200,000 employees as active users of AI on a daily basis inside of JP Morgan. And what I can't show you, and frankly, I don't need to or want to show you, is that the savings that that's creating about taking away all the things that we just talked about for the first half of this panel, all the no joy work. First, you eliminate that. Then you get on to helping the client, giving them more insights, protecting them better, recognizing patterns that the human eye can't see, being able to stay ahead of the bad guys, and helping all of the CEOs that I see in this audience to help win and move faster. And so you look at that and you say to yourself, this is an incredibly exciting time. What it doesn't necessarily translate itself into is to job cuts, as you referred to, because most of the CEOs and companies I see see here, and particularly on the panel, are in growth mode. And so I can't disprove the negative. I can't tell you I didn't hire those next 5,000, 10,000 people, but we're not. We don't have to hire those net new people. We can keep who we have. We can reinvest in them. And if they go along the journey with us on this AI very exciting time for the world, they will all be endgame winners. And the clients, the end user, will have a much, much more just powerful experience. Everything will be hyper-personalized to them. It will be in the banking system as if they're walking around with their own CFO right next to them.
Okay, can I just amplify the point that Mary made? Because I think it's absolutely key. Of course, the advent of AI, as well as all the automation tools that we're developing, will displace particular roles. We're all completely committed to reskilling the people that are in those roles to the extent that they want to be reskilled, and most do. AI is an enormous enabler for that reskilling. And augmented intelligence, in addition to artificial intelligence, will allow people who haven't been able to acquire those skills in any formal way to acquire them quite quickly, or to have them complementing their intrinsic skills to be able to be employable in the new world. So, of course, some people will be dislocated. There will be anxieties along the way. But I think the employees will be huge net winners through this. And as Mary said, of course, the clients will be, and shareholders will be, because we're going to be more productive.
Venkat, you're nodding your head.
Yeah,
Go for
look,
it.
I agree with everything. And I think to bring back an earlier point, which we said, you have members of the banks and financial industry here. But this is something that is changing the real economy in fundamental ways, not just how other people are doing their work, but also the investments that are being required. We just put out a research report from Barclays which said that the amount of power demand that AI is going to require in the US is going to be orders of magnitude greater than what we thought it would be. But we look even beyond at the fundamental industries that are changing and have been changing in the last dozen years because of what's going on in computation. The automotive industry is being completely reimagined electrically. You're getting the same changes happening in the way people develop drugs. You are getting what's happening in power and power generation. Remember, these are 100-year-old industries. These were the sleepy part of our economy. No longer, they're the snazziest part of our economy. And that's what's going to happen. And similarly in banks and in service sectors, the way we deliver services to people is going to be completely different, and it's going to make it easier and better.
Bill, slight change of tact, but I do need to ask you about this. Banks over the years have been asked to take on several leadership roles, and you yourself, as CEO of Standard Chartered, you've also taken it upon yourself to sort of be an advocate for the bank's role in bringing forward a sustainable economy. It feels as though the mood music has changed. Many of US peers have pulled out of the climate alliance. Even Trump, yesterday, President Trump is now has plans to pull out of the Paris framework. Big setback to the green agenda. How is this going to impact the bank's role in promoting this sustainable economy? And is it necessary to have a rethink of banks' leadership on this domain?
Well, I think everybody's sort of thinking all the time about how we can have the best effect and affect the outcome most efficiently. Look, the Paris Agreement set out a 1.5 degree ambition. Less than 2 degrees was the sort of the criteria. Very few scientists believe today that we can hit 1.5, and then 2 degrees is very much at risk. And of course, we're seeing the consequence of that in terms of the natural disasters around the world. Importantly, I think, while there's been a clear shift in narrative, in particular in the U.S., also some other places, as far as I know, no banks have withdrawn their commitments to supporting a transition to a net zero economy, nor have any of the large oil-producing countries, obviously Qatar being one, who's got a fantastic sustainability program, because in the long run, it's pretty clear that we need to disgorge ourselves from the reliance on fossil fuels. But when we set this up at Standard Chartered in the beginning, it was 2 prongs. One was we've got to do our bit to do the right thing vis-a-vis our clients, because they want to transition to a net zero environment, but it requires massive investment. That's what we do. We come up with those dollars. But 2 is we make money. Right? It's a big business for us, and we made we gave the guidance externally a couple of years ago that we'd make $1 billion of income by 2026. We'll be pretty close to that in 2025. It's just a big business, and it's a profitable business. So I don't want to sound too mercantilist about it, but we do the right thing and we get paid for it. It's kind of win-win.
Yeah. Mary, I don't know if you want to weigh in on that and whether you think that the requirements that have been put on banks have been a lot and too onerous. And to Bill's point, it doesn't necessitate you actually being part of an alliance for you to stick to climate commitments.
Absolutely not. I mean, I think on the climate front, everyone wants a green planet, and so we're all working towards that. But you have to have energy security, you have to have proper energy transition, and you have to have public and private partnership, and all of us are working towards that. We don't need different bodies of people to come together to tell anyone that. Our clients ask us to do that. We're one of the largest financiers of the green economy. We finance 1 in every 4 deals. We would do more if the other people on the panel weren't so competitive with us. But it's very important that we all invest. And I'm looking at all these investors, again, in the audience, and it's a very exciting time to be doing all this. You compound that with AI, and you can take yourself to, as Robin said, like areas we don't even know what we're going to find, and it's going to be a really exciting time.
Yeah. Well, Mary said that, I mean, you've been on these panels many times over the last few years, regulation a big theme, but also, you know, the preponderance of fintech players, challenger banks, and this has been a theme for a very long time. Robin, let me just ask you how you see the competitive landscape with fintech players, with, again, a resurgence and interest in digital assets, and clearly that's also going to be a focus for the Trump administration, big support there from the crypto industry, and whether or not you see this opening up opportunities in the future.
Well, competition is a good thing, and Mary just referred to it. You know, we compete, but we don't just compete with each other. We also compete with all sorts of different companies, and you mentioned some in the fintech space, and we also partner with them. So we use fintechs, and they use us as well. A lot of you talked about the digital asset firms, a lot of them run on rails that are built by BNY for some of their traditional purposes. You know, we provide platforms around payments, around collateral, around custody, around issuer services, and many of them use those rails as part of it. And so this is a place where there are new technologies, new capabilities, they're infusing into the financial system. That's good, it's advancing, and it's both players like us. We've been around for over 240 years. We're always innovating. That's how you get to be old, by being an ongoing innovator. And we're partnering with the new firms that are coming along and also learning from them, and they're using us.
Yeah. Venkat, yesterday I interviewed the Mubadala deputy CEO, and he told me that their best performing asset has been private credit. And you can't have a conversation these days about markets without getting into the world of private credit, but it also is a reflection of how many different players there are in this market now. And I wonder whether you feel like, as a bank, your territory is being encroached on. How do you view the competition there?
It's a bit like Robin's answer. So first of all, private credit has existed for a long, long time. Those of us who are banks here have been around in that business for over 100, 150 years. We used to make loans. We still make loans. We hold them onto our balance sheet. We don't trade them. That's private credit, more or less. What's happened, and this is happening over the last 50 years, is that the share of bank ownership of lending. So total lending in an economy grows roughly at the rate of GDP, and it's done that for 25, 50, 75 years. The question then is, who does the lending, right? And that lending used to be over 50% by banks about 25 to 30 years ago. It started declining, in part because of capital rules, but for other reasons. Some of it went into mutual funds and to asset managers, like represented by Mary and some others in this room. And then we've got a new form of asset manager who's buying private credit. And in fact, even in the asset management space, you know, Mary and I began together in JP Morgan Asset Management many, many years ago, and we used to have something called the Private Placement Credit Fund. And so we were doing it 30 years ago. And so that's been there. The shift is happening to a new owner. What is the long-term percentage that owner is going to have? Let's see, right? Because these things go up and down. But banks will always have a role in credit formation and credit origination, because not just do we lend to these companies, we do a whole bunch of ancillary services for these companies, including their payments, their deposits, and various forms of financial activity.
Yeah.
So that will not change.
And I'll just add one thing. His Excellency is both the central bank governor, but also a very large investor in the rest of the world. And when you think about very large sums of capital that say, I want to get access to all of these companies that are being financed, whether it's in the public markets or in the private markets, if I don't have to pay public market premiums, I'd rather just go to the public markets. And if I don't need my money on a daily liquid basis because I'm a long-term investor for my participants in decades from now, then that's where they're going to go. So you have to follow where the client wants to go and what's the best value for the client. And that's all you're seeing playing out here in this marketplace.
Yes, Joumanna. Actually, now, those days, there is an increased competition to the financial sector from non-traditional financial institutions such as fintech, private credit, as well as telecommunication. Now they are requiring financial licensing. So the competition is increasing, which put the pressure on the banks. But I think by investing in innovation, by implementing technology, and investing in digital transformation, that will help the bank to grow and to compete in this area. People now, the people behavior has changed. People now more with utilizing and using technology, using internet, using applications. So the banks need to adapt with the new transition. As well as that, I really suggest that the banks, as my friends here just mentioned, to partner with fintech to leverage on their innovation and technology. However, we don't want to also to forget one important aspect here, that the technology the new technology emerging comes with its risk, especially the cyber security risk. And this is a very important area where the banks and regulator need to also to focus and to monitor very closely to protect the customers' data, to protect the customers' money as well. What we have witnessed in 2023, what we call it one-click banking with SVB, the customers will be able to transfer 85% of their deposits in just 2 days.
Yeah.
Imagine in 2 days transferring 85% of their deposits. That wouldn't happen historically for weeks. Yeah. So the quick response is very very important as well.
Yeah. Well, I'm going to give you the final word then, Your Excellency, which is, based on everything that we've discussed over the last 45 minutes or so, what does the Bank of the Future look like in 10 years' time?
Okay. From my point of view, I think that the bank in the future will be less visible. And what I mean here, that the bank will invest heavily in digital transformation. As I mentioned, people behavior has changed, and the bank will adapt to the people behavior. The banks might be in the future one-stop mega store offering various personalized product and services to compete in this world, as well as the bank will be more nimble in their operation, will utilize more technology, and will invest more in the technology, will be more efficient in the future.
Okay, that's the hope. I'm going to open it up to a couple of questions. Who would like to go first? Any questions from the audience? Yes. Over there.
Hello, John Paul Ford-Rocas from the Daily Mail in the UK. This is probably mainly for Venkat and for Bill, but in terms of the UK and operating in the UK as you do, the new government started off with a great deal of optimism 6 months ago. Growth has stagnated since then, and confidence about the year ahead is kind of crumbling. So I just wondered what your take is as of now, on your operations in the UK, sentiment going forward, what you want the government to do to try to boost growth?
Venkat, you kind of touched on that, but if you want to...
I see Bill is very happy with this. Well, look, I actually disagree with the premise of a lot of what you said. First of all, economic releases have to be looked at over a very long period of time. The UK has been in a period of basically what I would call low to substandard growth for years. Second is interest rate cycles also play out over very long periods of time. 30 to 40 basis point changes in interest rates are fairly common. So what you've seen in the last few weeks in the UK is just UK yields, gilt yields moving up and then down with basically global yields and not moving that differently. The UK, as I said earlier, has a lot of potential. The new government has laid out plans to realize on that potential. It's, as you said, new, 6 months old. And so you just have to give it time to get the policies in place, because these things are not easy. As Robin said, you know, if you think of governments as companies, you've got to align all your constituents, you've got to go on it. And all of us working in large companies know it doesn't happen overnight. So I think all the raw material is there, all the potential is there, just got to give it time.
Yeah, I would just add that Venkat clearly has more exposure to the UK economy than Standard Chartered Bank does, but we operate there as our headquarters. We're regulated there, and we're subject to taxation, et cetera. I will say that this government is listening. They're proactive, they're pragmatic, and while I think they've had a little bit of trouble finding their grip in the early days, I have every confidence that they will.
Okay. Question back there.
Morning. My name is Roberto Patiño. I'm a YGL from Venezuela. The first part of the conversation was mostly about regulation and how it hurts growth. And what I heard from Mr. Winters specifically is that one of the reasons is because it requires a lot of manpower to comply with all these intrusive regulations. I was wondering whether you see AI as a solution for that instead of deregulation. Is there a use case for AI to solve this or to comply with these regulations instead of going the route of deregulation?
I think we would all probably agree that the initial use cases for AI in all of our shops was compliance. And starting with anti-money laundering and sanctions compliance, things like that, but then moving on to fraud detection and regulatory reporting, making sure it's consistent. So I think AI is already deeply embedded in the regulatory framework. Where it's probably less developed is in the regulator itself. So assimilating the massive amounts of data that regulators are getting from all of us every day, like hundreds of thousands of data points every day, millions in some cases. The ability to synthesize that into some coherent trends and some coherent findings, I think will be one of the big opportunities for regulators in the years to come.
Can I just add one thing, which is to make sure that we don't leave you with the impression that somehow we're against regulation, because I don't think any of the leaders on this panel are. We just want the right, smart regulation that enables our businesses to be able to help economies grow around the world. And there's been great progress that's been made by regulators over the 10, 15 years following the financial crisis. But our point is that we've achieved, at least for the largest financial institutions, we've achieved the goal. And so now that we've achieved that goal, and we think we've created the safety, the stability from the extra liquidity, the extra capital, now it's the opportunity to be able to put all of that to work to power the economy, to enable the growth that we know the world needs, that so many countries and people around the world want. And so good regulation, public-private partnership. Now let's get after the opportunity. We're not trying to have some massive rollback and go to a world of 20 years ago, which we would all agree was not great and was not great for our businesses either.
That's right.
Yes, I would like to add a few, yes. Actually, I do agree with Bill, what he mentioned, that regulator, they need to also to adapt to the changes, and regulator need to implement the technology. So what I mean here and refer that in Qatar Central Bank today, we are embedding AI in our day-to-day operation. For example, we have just recently developed our RTGS system, and we are also integrating AI to monitor the liquidity in the system. This is what we need, that not just one side of the market that implementing technology, also the regulator, they need to adapt and implement the technology to catch up with the market and the improvement in the market.
Yeah, very valid point.
Yeah,
Mary, you wanted to say
I would just end with the fact that the whole reason that banks exist is simply to facilitate the growth of the global economy. And we're here to serve our clients. Our clients need to go with this economy that we have today in the world. It's a very exciting time, and us being able to use our balance sheets to help facilitate that growth is exactly what we should be doing. And I think we're gonna embark on an era of really exciting times here.
I've got time for one final question. Yes, lady in red.
Thank you so much. Good morning. Jennifer Schonberger with Yahoo Finance. Mary, question for you. How are you looking at what President Trump has laid out as far as economic policy on tariffs, mass deportations, tax cuts, aside from lighter regulation touch, and how that will impact the economic outlook? Thank you.
All that in 90 seconds.
Yeah, well, I think the last 24 hours are just showing that there's going to be a lot of changes that we all have to digest. At JP Morgan, we have a war room set up to analyze and evaluate each and every one of these. So they've been up all night and are working on it. And I think that, you know, time will tell. But a lot of this is exactly what you would do to have a very pro-business environment. You look at just the return to office for government workers. And so you just say to yourself, that's exactly what this whole panel has already done. Thank God the US government has done it, and hopefully that'll keep us ahead of other governments in the world so we can continue to compete.
Not competitive at all over there. Panelists, thank you so much. This was a real pleasure, really insightful conversation, and thank you all for watching our panel.